Overtrading is one of the most common yet least recognized traps in trading. It rarely feels like a mistake while it's happening. In fact, it often feels productive. You're active, engaged watching charts, placing trades, managing positions. It feels like progress. But that feeling can be deceptive. Beneath the surface, excessive activity quietly erodes performance, clarity, and long-term consistency. In most areas of life, action produces results. The more hours you work, the more you accomplish. The more effort you put in, the more you get out. Trading does not follow that rule. In trading, more action does not automatically create more profit. Sometimes it creates the opposite. Constant activity feels like progress because it gives the illusion of control. When you are entering trades, adjusting stops, and reacting to every move, you feel involved. You feel like you are doing your job. Sitting still, on the other hand, feels uncomfortable. Waiting can feel lazy. Trading, waiting is not laziness. Waiting is discipline. Waiting is often the highest quality position you can take. Modern market accessibility has amplified this problem. With mobile apps, instant execution, and real-time charts, there is no friction between impulse and action. Years ago, placing a trade required more effort. Today, it takes a tap. When action becomes effortless, impulsive behavior increases. The easier it is to trade, the harder it becomes to avoid unnecessary trades. Overtrading is rarely a strategy problem. It is usually an emotional regulation problem. Missing out is one of the strongest drivers. Markets move quickly. A candle spikes. A breakout forms. You imagine the profit you might miss. The thought of sitting out becomes more painful than the risk of entering without confirmation. That urgency overrides patience, and patience is essential for selectivity. Boredom also plays a powerful role. Watching charts for hours creates restlessness. The brain craves stimulation. Small price movements begin to look meaningful simply because they offer something to focus on. Trading slowly shifts from execution of a plan to a way of relieving boredom. Act of entering a trade triggers a small dopamine response. That chemical reward reinforces the behavior, even if the trade itself has no edge. Losses create another dangerous emotional trigger. After a losing trade, especially an unexpected one, there is an immediate urge to recover. You want to get back to break-even. You want to erase the discomfort. This is where revenge trading begins. The focus shifts from following the process to fixing the outcome. Risk limits get stretched. Criteria become flexible. What feels like determination is often emotional reaction. Instead of repairing the damage, it usually multiplies it. Winning streaks can be equally dangerous. After a few profitable trades, confidence increases. Confidence is necessary, but unchecked confidence turns into overconfidence. You begin to believe you see the market clearly. You start trusting instinct over structure. Position sizes grow. Frequency increases. Standards loosen slightly. The edge becomes secondary to the feeling of momentum. Both fear and overconfidence push traders toward excessive activity. The emotional state changes, but the result is the same. More trades, more exposure, more opportunity for error. The costs of overtrading are not just psychological, they are mathematical. Every trade carries transaction costs. Spread, commission, slippage, these small frictions accumulate over time. Strategy that performs well at moderate frequency can become unprofitable when the number of trades doubles. Many traders underestimate how much profitability is lost through sheer volume. Beyond financial costs, there is cognitive cost. Every trade requires decisions. Entry timing, placement, position management, exit strategy. The human brain has limited decision-making capacity. As trade frequency increases, mental clarity decreases. Fatigue sets in. When mental energy drops, discipline weakens. Rules that seemed solid earlier in the day begin to bend. Small shortcuts appear justified. After several rapid trades, objectivity becomes harder to maintain. You are no longer looking at a neutral chart. You are looking at it through the lens of recent outcomes. You just lost, you may hesitate on a valid setup. If you just won, you may overestimate the next one. Perception becomes biased. Emotional residue from previous trades contaminates new decisions. Small mistakes rarely destroy accounts in isolation. It is repetition that creates damage. Slightly early entries, slightly wider stops, slightly lower quality confirmations. When these small imperfections repeat across many trades, they compound. More trades mean more decision points, and more decision points increase the probability of deviation from your system. Is where the quality versus quantity problem becomes clear. As frequency increases, standards naturally decline unless actively protected. You begin accepting setups that are close enough instead of clear and aligned. You convince yourself that a trade almost fits your criteria. The trade no longer fits the plan. Quietly adapts to justify the trade. Discipline rarely collapses suddenly. It erodes gradually. One exception becomes two. Two become habit. Over time, you move from structured execution to reactive behavior. You are no longer trading your edge. You are trading noise. Consistency in trading does not come from catching every move. It comes from capturing the moves that belong to your strategy. High-level performance is built on selectivity, saying no more often than you say yes, preserving mental clarity, protecting emotional stability, guarding attention like capital. More trades increase exposure to error. Even with a positive expectancy system, increasing frequency beyond optimal conditions adds more opportunities to mis-execute. Edge is not just about statistics, about behavioral stability. The more often you act, the harder it becomes to maintain perfect discipline. Selectivity strengthens consistency because it reduces noise, filters marginal opportunities. It protects mental energy. It creates space between decisions, allowing objectivity to reset. Fewer trades can produce smoother equity curves, not because the market changes, but because execution improves. Overtrading is deceptive because it feels like ambition. It feels like effort. It feels like commitment. Trading is not a game of effort. It is a game of precision. Activity is not the goal. Clarity is. Patience is. Alignment with your edge is. True progress in trading is not measured by how busy you are. It is measured by how well you can wait, how strictly you can filter, how consistently you can execute when the right moment finally arrives. Selective trading is not just a psychological preference. It is a mathematical advantage. While overtrading damages discipline, selective trading strengthens statistical edge. The difference between the two is not emotional, it is numerical. When you understand the mathematics behind performance, patience becomes logical rather than forced. At the core of trading performance lies expectancy. Expectancy is the average amount you can expect to win or lose per trade over a large sample size. It is calculated using three main components of win rate, risk to reward ratio, frequency. Win rate is simply the percentage of trades that end in profit. To reward ratio measures how much you gain on winning trades compared to how much you lose on losing trades. A system with a 50% win rate and a 1-to reward ratio can be highly profitable. A system with a 70% win rate and a 1-to-1 ratio can also work. What matters is how these variables combine. Many traders assume that increasing frequency increases income. The logic seems simple. If one trade produces profit, then more trades should produce more profit. Expectancy does not scale linearly with frequency. If trade quality declines even slightly as frequency increases, expectancy drops. And when expectancy drops, performance deteriorates even if trade count rises. For example, a strategy with strong criteria may deliver 10 high-quality setups per month. You begin forcing additional trades to reach 25 setups, those extra 15 are likely lower probability. Even if they only reduce your win rate by a small percentage or slightly worsen your average reward, to risk ratio, the long-term impact becomes significant. More trades do not guarantee higher returns. They often dilute the edge that made the system profitable in the first place. Beyond expectancy, transaction costs quietly compound. Every trade carries friction. Commissions, spreads, and slippage reduce net performance. At low frequency, these costs may appear negligible. Frequency rises, they accumulate rapidly. A strategy that generates small but consistent gains can become break-even, or even negative, once execution costs are factored across hundreds of trades. Spread widening during volatile conditions adds another layer. During news events or sudden price expansions, spreads often increase. Short-term traders who operate with tight stops are especially vulnerable. A slightly wider spread can shift a trade from viable to unprofitable. When trading frequently, you expose yourself to these micro-cost fluctuations repeatedly. Short-term strategies are particularly sensitive to transaction cost compounding. The average profit target is small, costs represent a larger percentage of potential gain. In such cases, increasing frequency without increasing average reward reduces net edge. Selective participation helps maintain favorable cost-to-reward balance. Another mathematical reality many traders overlook is variance. Even profitable systems experience random distributions of wins and losses. A system with a 60% win rate does not produce 6 wins after every 4 losses in perfect order. Results cluster unpredictably. You may encounter 5 losses in a row despite having a statistically sound approach. Higher trade frequency increases exposure to variance. More trades mean more opportunities to encounter losing streaks within short periods. While the long-term expectancy may remain positive, term emotional experience becomes more volatile. Consecutive losses carry psychological weight. The human brain struggles with randomness. When losses cluster, increases. Traders begin questioning the system, adjusting rules prematurely, or increasing size to recover faster. The emotional response to variance often causes more damage than variance itself. Selective trading reduces unnecessary exposure to these probability clusters. Fewer trades mean fewer chances of encountering statistically normal, but emotionally difficult, streaks within compressed timeframes, preserves mental stability and reinforces adherence to the plan. Drawdown dynamics also change with frequency. Drawdown is the peak to trough decline in account equity. Higher trade frequency, drawdowns can occur faster. Even if the percentage loss is similar over time, experiencing it quickly intensifies pressure. Percent drawdown over 3 months feels different from a 10% drawdown over 1 week. The speed amplifies emotional stress. Faster drawdowns increase the likelihood of impulsive decisions, risk parameter violations, and deviation from the system. Recovery mathematics makes this more challenging. Percent loss requires approximately an 11% gain to recover. A 20% loss requires a 25% gain. As drawdowns deepen, the required recovery percentage increases non-linearly. When excessive trading accelerates losses, it also increases the mathematical burden of recovery. Regaining losses carries psychological pressure. Traders feel urgency to return to previous equity highs. That urgency often results in increased risk-taking, larger position sizes, and reduced selectivity, exactly the behaviors that created the drawdown. The cycle reinforces itself. Selective trading interrupts this loop. By reducing frequency, you reduce exposure to unnecessary variance, lower transaction cost accumulation, and slow the pace of drawdowns. This stabilizes the equity curve. Sustainable statistical advantage is not about maximizing trade count. It is about optimizing trade quality. Fewer trades with higher probability setups typically improve risk-adjusted returns. Adjusted performance measures how much return you generate relative to the volatility of those returns. Stability matters. An equity curve that rises steadily, even if modestly, compounds more effectively than one that swings aggressively. Large fluctuations reduce psychological resilience and increase the chance of behavioral errors. Stability preserves confidence and supports long-term execution. Selective trading enhances clarity. When you know you will only act under specific, predefined conditions, fatigue decreases. Emotional noise reduces. Each trade carries intention rather than impulse. Over time, this selectivity strengthens expectancy. By filtering out marginal setups, you protect your win rate and maintain favorable reward to risk structures. You also minimize exposure to transaction cost drag and variance clustering. The mathematics is straightforward. Edge multiplied by disciplined execution over time creates growth. Increasing frequency without preserving edge reduces that multiplication factor. More action does not equal more profit. Precision equals profit. The goal is not to trade often. The goal is to trade well. A sustainable approach respects probability, manages variance, controls cost, and protects psychological capital. When you align frequency with quality rather than emotion, performance more stable and statistically defensible. Selective trading is not passive. It is strategic restraint. It is understanding that long-term success depends less on how many opportunities you touch and more on how carefully you choose them. Trading less is not a sign of hesitation, often a sign of maturity. Many traders focus heavily on strategy, indicators, and entry precision, yet overlook one of the strongest competitive advantages available to them: psychological stability. The less you trade, the more you protect your mental capital. And mental capital is just as important as financial capital. Every decision you make throughout the day consumes cognitive energy. In trading, each chart review, each entry, adjustment to stop, loss, or target adds to that mental load. When you trade excessively, decision fatigue accumulates quickly. Decision fatigue reduces your ability to think objectively. It weakens impulse control. It makes you more reactive and less analytical. Mind does not evaluate risk properly. It shortcuts analysis. It seeks quick conclusions rather than accurate ones. Over time, constant decision-making drains clarity and increases the probability of mistakes. Trading less preserves that energy. When you only engage during high-quality conditions, your mind is sharper and more deliberate. Emotional exhaustion is another hidden consequence of excessive trading. Every trade carries emotional weight. Even small positions create subtle tension. Wins generate excitement. Losses generate disappointment. Multiply that by dozens of trades, and you create a roller coaster effect throughout the day. Emotional highs and lows compound into exhaustion. When emotional reserves are depleted, impulsive behavior increases. You begin reacting instead of planning. You trade to relieve discomfort rather than to execute an edge. By reducing frequency, you reduce the number of emotional spikes. Fewer emotional swings create a more stable internal environment. Stability strengthens discipline. Trading less also improves decision quality. When you know you will not take every minor fluctuation, you become more selective during pre-trade analysis. Instead of scanning for any possible signal, you scan for alignment. You ask deeper questions. Is this setup fully aligned with my criteria, meet my risk to reward threshold? Is the broader structure supportive? Clarity improves when urgency decreases. If you feel pressure to constantly participate, your standards inevitably slip. But when you are comfortable sitting out, you wait for confirmation. You allow setups to fully develop rather than anticipating them prematurely. That patience often improves entry timing and risk placement. Avoiding marginal setups is one of the strongest psychological advantages of trading less. Marginal trades are tempting because they almost fit the plan. They look close enough. But almost rarely produces consistent performance. When you filter aggressively, you eliminate grey areas. You trade when conditions are obvious, not when they are arguable. This approach reduces internal conflict. Doubt is lower when trades clearly match your framework. Confidence increases because decisions are grounded in structure rather than impulse. Emotional stability naturally follows. Lower frequency reduces stress levels. Instead of feeling constantly exposed to market fluctuations, experience define moments of engagement. You are either in a trade aligned with your plan or you are patiently observing. That binary clarity reduces anxiety. Frustration cycles also decline. In high-frequency trading without strict filtering, losses can cluster quickly, triggering emotional spirals. You lose, you react, you lose again, and frustration escalates. Trading less interrupts this pattern. With fewer trades, you reduce the probability of rapid emotional stacking. Confidence becomes more durable as well. Confidence built on random wins is fragile. Confidence built on disciplined execution is resilient. When you repeatedly follow your rules and only act on high-quality setups, you reinforce positive identity. You begin to see yourself as a disciplined trader, not an impulsive one. Trust in the process develops through repetition. Each time you wait for a proper setup and execute according to plan, strengthen belief in your methodology. Consistency builds internal evidence. That evidence reduces the urge to interfere with the system after short-term losses. One of the most powerful psychological shifts that comes from trading less is the reduced need to make back losses. When you are selective, you understand that outcomes are distributed across a series of quality setups. A single loss does not require immediate correction, simply part of the statistical sequence. This mindset eliminates urgency and protects discipline. Over time, a reinforcing cycle begins to form, leads to better trade selection. Better trade selection improves average outcomes. Improved outcomes strengthen confidence. Stronger confidence makes patience easier, creates what can be called a discipline loop. Patience leads to better trades. Better trades lead to improved results. Improved results strengthen discipline. Stronger discipline reinforces patience. Contrast this with the overtrading cycle. Impatience leads to marginal trades. Marginal trades produce inconsistent results. Consistent results create emotional stress. Emotional stress weakens discipline. Weakened discipline increases impulsivity. The cycle feeds itself in a downward spiral. The difference between these two loops is not intelligence or talent. It is frequency control and emotional regulation. Trading less does not eliminate risk, but it reduces unnecessary psychological strain. It allows you to operate from a position of clarity instead of urgency. In the long run, performance is shaped not only by strategy but by mental sustainability. A trader who preserves mental capital can execute consistently for years. A trader who constantly drains cognitive and emotional energy burns out, even if the system itself has potential. The psychological edge of trading less is subtle but powerful. It protects focus. It strengthens discipline. It stabilizes emotions. It builds trust in the process. Most importantly, creates an internal environment where high-quality decisions can thrive. In trading, survival and consistency matter more than constant action. Sometimes the strongest position you can take is the one where you do nothing until the right moment appears. Selective trading is not simply about trading less. It is about building a structured framework that makes selectivity measurable and repeatable. Without structure, the intention to be disciplined fades under pressure. A strategic framework turns patience into a system rather than a temporary mood. First step is defining what a high probability setup actually means within your methodology. Many traders believe they know their edge, but their criteria remain vague. Vague rules create flexible decisions, and flexible decisions invite impulsive trades. A high probability setup must be defined with clarity. Start with a checklist. Clear, objective criteria reduce emotional interpretation. For example, you might require specific market structure alignment, such as higher highs and higher lows in an uptrend or clear range boundaries in consolidation. You may require confirmation from multiple timeframes. You may demand a minimum risk to reward ratio before entry. Whatever your edge is, translate it into observable conditions. Market structure alignment is essential. Trading against dominant structure significantly lowers probability. When price is trending strongly, countered trend trades require exceptional justification. Prices ranging, breakout trades demand evidence of genuine expansion. Structure acts as context. Without context, signals lose reliability. Confluence adds another layer of quality. Confluence refers to multiple independent factors aligning at the same price area or moment. Might include support and resistance zones, liquidity areas, momentum shifts, or volume confirmation. The more independent factors that align, stronger the potential setup. Confluence filters randomness. Predefined invalidation levels are equally critical. Before entering a trade, know exactly where the idea is proven wrong. This eliminates emotional stop adjustments after entry. Invalidation is not based on discomfort. It is based on structure. When invalidation is predetermined, risk becomes controlled rather than reactive. Beyond defining setups, frequency must be limited intentionally. Trade quantity is not capped. Emotional impulses will often increase participation. Setting a maximum number of trades per day creates built-in restraint. Once that limit is reached, no more trades are allowed regardless of opportunity. This prevents emotional spirals after wins or losses. Weekly trade limits add another layer of control. A maximum number of trades per week encourages prioritization. Instead of taking every possible setup, participation for the best ones. This automatically improves average quality. Time-based restrictions can also be powerful. For example, trading only during specific sessions when liquidity is strongest reduces exposure to erratic movement. Some traders restrict activity during major news events. Avoid low-volume periods where false signals are common. Time filters improve clarity and reduce unnecessary exposure. Risk management must align with selectivity. Fixed percentage risk per trade ensures consistency across outcomes. Whether you risk 1% or less, the key is stability. Increasing risk after losses or wins disrupts the statistical foundation of your system. Controlled exposure across multiple trades is equally important. Even if individual trades follow risk parameters, overlapping positions can create hidden concentration risk. Avoid stacking trades in highly correlated instruments or similar market directions. If several positions depend on the same underlying move, you are effectively amplifying risk beyond your intended level. Selective execution requires awareness of correlation. Markets often move in clusters. Taking multiple trades that respond to the same macro driver increases vulnerability during reversals. Spreading exposure or limiting simultaneous positions protects capital stability. Adapting to market conditions further strengthens the framework. Do not behave the same way at all times. Trending environments reward pullback entries and breakout continuation strategies. Ranging conditions favor mean reversion approaches. Applying the wrong strategy to the wrong environment reduces probability dramatically. Volatility conditions also matter. During volatility expansion, price moves aggressively and spreads may widen. During contraction, breakouts frequently fail. Recognizing whether volatility is expanding or compressing allows you to adjust expectations and participation levels. There are times when standing aside is the most strategic decision. Periods of high uncertainty, conflicting signals, or unclear structure increase randomness. Selective traders recognize that capital preservation is part of performance. Avoiding low-clarity environments protects both financial and psychological resources. No framework is complete without review and refinement. Trade journaling transforms experience into data. Each trade should be documented with entry reasoning, crotch risk parameters, emotional state, and outcome. Over time, patterns emerge. You identify which setups truly perform and which ones underdeliver. Weekly performance reviews provide perspective beyond individual results. Instead of reacting to one loss or win, you analyze trends in execution. Did you follow criteria? Were stops adjusted impulsively? Did you exceed trade limits? Consistency in review strengthens accountability. Identifying impulsive trades is particularly valuable. Mark any trade that violated rules, even if it was profitable. Profit from a rule-breaking trade reinforces dangerous habits. Separating disciplined trades from impulsive ones allows you to measure execution quality independent of outcome. Continuous improvement is a cycle. Define criteria selectively. Review results. Refine rules. Recommit to discipline. Each cycle strengthens structure. Over time, your process becomes more precise and decision-making becomes more automatic. Selective execution is not about avoiding opportunity. It is about refining participation. By clearly defining high-probability setups, limiting frequency intentionally, aligning risk management, adapting to market conditions, and reviewing performance consistently. You create a sustainable system. In trading, structure creates freedom. When rules are clear and execution is selective, emotional noise decreases. You are no longer reacting to every fluctuation. You are responding only when conditions meet your defined advantage. That is the essence of strategic discipline. Long-term wealth in trading is rarely built through constant activity. It is built through preservation, restraint, and disciplined repetition of high-quality decisions. Selective discipline may not feel exciting in the moment, but over time it creates stability, and stability creates growth. Primary objective of any serious trader should be capital preservation. Before profit, before expansion, before scaling, survival comes first. Large drawdowns damage more than your account balance. They damage confidence, clarity, and emotional control. Avoiding deep equity declines protects not only money, but also decision-making capacity. When drawdowns are shallow and controlled, recovery is manageable, but when losses accelerate due to impulsive overtrading, the psychological burden increases dramatically. Fear replaces objectivity. Urgency replaces patience. Protecting capital keeps your emotional baseline stable, and emotional stability supports consistent execution. Preserving capital also protects the power of compounding. Compounding thrives on consistency. Even modest monthly returns can grow significantly over time if volatility remains controlled, but compounding cannot function properly when gains are repeatedly erased by preventable losses. Large setbacks interrupt growth cycles and require disproportionate effort to recover. Selective discipline reduces the frequency of large mistakes, and wealth in trading is less about maximizing wins and more about minimizing errors. Small, consistent returns, applied repeatedly over time, produce exponential growth. Key is sustainability. Fewer mistakes mean fewer emotional disruptions. Every impulsive trade carries the risk of regret. Regret erodes confidence. Confidence influences execution. By reducing unnecessary trades, you reduce emotional turbulence. Stability improves your ability to think clearly across months and years rather than days. Long-term statistical advantage depends on disciplined repetition of your edge. Strategy with positive expectancy only works if executed consistently. Random deviations introduce noise into the data. Over time, noise dilutes edge. Selective traders understand that protecting the integrity of the process is more important than chasing short-term gains. Designing a personal activity threshold is a crucial step toward long-term consistency. Not every trader is wired the same way. Some personalities thrive with moderate activity, while others perform better with minimal exposure. The goal is to find a sustainable rhythm that aligns with your temperament. If you are naturally impulsive, high-frequency trading may amplify emotional instability. If you are analytical and patient, forcing yourself into rapid decision cycles may degrade performance. Matching strategy to personality reduces internal friction. When your trading style fits your temperament, discipline requires less effort. Avoiding comparison is equally important. Watching other traders post frequent trades or rapid gains can create pressure to increase activity. But your threshold is personal. Tolerance, emotional resilience, and cognitive style are unique. Long-term wealth comes from consistency within your own framework, not imitation of others. Selective discipline also shifts focus from activity to preparation. Instead of measuring productivity by the number of trades placed, by the quality of preparation completed, study market behavior, review historical patterns, refine entry criteria, analyze previous trades. Preparation strengthens execution without exposing capital to unnecessary risk. Scenario planning becomes a powerful tool in this process. Rather than reacting in real time, potential outcomes before the market moves. Identify key levels. Outline bullish and bearish scenarios. Decide in advance what conditions justify participation. When scenarios are prepared, execution becomes calm and deliberate rather than reactive. Patience is not passive. It is preparation in motion. Waiting for alignment while knowing exactly what you are waiting for transforms inactivity into strategic positioning. The more prepared you are, tempted you become to trade out of boredom or fear. Over time, selective discipline reshapes your relationship with the market. Trading stops being a constant search for stimulation. It becomes a structured process of waiting, executing, and reviewing. This rhythm protects both capital and mental energy. Perspective is simple but powerful. Trading is not about constant participation. Markets will always provide movement. Opportunity is endless. But capital is finite, and attention is limited. Every trade is a decision, and every decision consumes resources. Precision, not volume, determines longevity. Fewer decisions often lead to better decisions because clarity remains intact. When you reduce noise, signal becomes easier to see. When you reduce frequency, quality naturally rises. Long-term profitability favors restraint over impulse. It rewards those who can sit still while others chase movement. It rewards those who treat capital with respect and process with discipline. Wealth in trading is not built through speed. It is built through stability. Selective discipline may feel slower in the short term, but in the long term it compounds quietly and powerfully. And in trading, quiet consistency almost always outperforms loud activity.